Today we're going to do another chapter in our journey of into managerial accounting, and that will be chapter 10, which is about the analysis of the standard costs. Before we move to an analysis of standard costs, I told you I want to make a link between today's chapter and previous chapter. In terms of, I want to bring you back to the budget. And last time, what we did was we prepared the static budget. What that means? That means that the static budget is the budget that exists only in certain reality. Which is that reality? The reality that we our sales plan. So if our sales are different than the numbers that we have in the beginning, if we achieve different sales than the one that we have in the very beginning, then all the budgets that we have prepared, production budget, direct material, direct labor, manufacturing overhead, sales administrative expenses, cash flow, cash budget, income statement, and balance sheet budget, none of them is going to work. So the static budget is good for planning, but however, for control, we have to move to the flexible budget. What will be the flexible budget? Flexible budget will prepare for the level of actual activity by applying the same principles and the same rules that we have when we preparing the static budget. So let's see static budget versus actual performance. Let's pretend that this company prepared the static budget for 10,000 machine hours. And at that 10,000 machine hours, they're expecting to have the indirect labor, indirect material, and power, and that kind of cost. 40,000 for the indirect labor, 30,000 for indirect material, and 5,000 for the power. For the fixed cost, they're expecting depreciation of 12,000 and insurance of 2,000. Company worked, and when the actual results came, they find out that they actually used the machine only for 8,000 hours. Because they're using machine now less hours, the indirect cost is lesser, 34,000. Indirect material is 25,500 and power 3,800, which is way lesser than we initially participated. Now the question is that helpful for us? We can easily see on the various analysis that we're not using the machine on the for the hours that we budget the machine. So we have unfavorable variance on the machine hours. That means we're not using, we're losing from the capacity of the machine. If we check the other costs, we can see that all the costs were favorable. Means that we're spending less. We're participating to spend 40,000 indirect labor. In fact, we spend only 34. That's $6,000 less, which is favorable for us. On the indirect material, we're expecting to spend $30,000, but we spent only $25,500. So that's $4,500 less than what we expect to spend. So that's again is a favorable variance for us. Now the question is, are those results accurate for control purposes? And since everything is favorable, did the company do a good job of controlling the cost? And the question is, we don't know. Why? Because we're comparing static budget with the actual budget, which are independent realities. Static budget was prepared for 10,000, anticipation for 10,000 machine hours of usage. In the actual results or in the real results, we work with the machine only 8,000 hours. So are we spending less because we use the machine less hours? Or are we spending less because we are good at cost? We don't know that. However, we can prepare a flexible budget for the actual level of activity. So what we're going to do, we're going to prepare the budget at 8,000 machine hours. How can we do that? We can do that having in mind that the variable cost per unit always stays the same, and total fixed cost always stays the same. Knowing those rules, we can easily come back to our static budget here, which we prepare for 10,000 units, and we can ask ourselves, if the variable cost is in direct proportion for the increase of the machine hours, and the total variable cost is $40,000, machine hours are 10,000, how much is the indirect labor cost for 1 hour? Can we calculate it? What will be my variable cost per unit here for the indirect labor? Knowing that the total cost is $40,000 and I use the machine for 10,000 hours. Can you tell me?
$4.
$4 per hour. Yes, you're correct. How about the indirect material? How much will be the cost for the indirect material?
$3.
$3. How about the power? How much will be the cost for power?
50 cents.
50 cents. How about the fixed cost?
$12.
Think about it. Fixed cost. Do I have to go for the unit level?
Yeah.
No, it's
No.
12,000 because
That's true.
it doesn't matter the production quantity.
Thank you so much. Yes, that's the tricky part. Know what is the stable cost. We already talked about it. Stable cost is the one that doesn't change. Which cost doesn't change from the variable cost? Total cost or cost per unit? For the
That's-
variable cost per unit is always the same, right? For the fixed cost, which one doesn't change? Total fixed cost or fixed cost per unit?
Total cost.
Total fixed cost never changes. Great, as long as we stay in the relevant range. So knowing those things and the cost that we just apply, now we can prepare different budget. We can prepare budget for 8 hours, 8,000 hours, for 10,000 hours, and for 12,000 hours. Once we prepare those budgets, we're going to have now 3 budgets, correct? For 8,000 hours, for 10,000 hours, or for 12,000 hours. As you can see, the total fixed cost, as long as we're in the relevant range, doesn't change. Variable cost per unit stays the same, but the total cost exponentially growing based on the usage of the machine hours. Once we have those 3 flexible budgets, now we can say, do we have a budget in our actual usage? And the answer is yes, we do. Actual results, or you use the machine for 8,000 hours. Do we have our budget for 8,000 hours? Yes, we do. So now we can compare static budget with the actual cost. Those are the numbers for our static budget. Now we can compare that static budget with the actual cost. So, based on our budget, if we use the machine for 8,000 hours, we expect our indirect labor hour cost, total variable indirect labor hour cost, to be $32,000. In reality, our indirect labor cost is $34,000. Is that good for us or not good for us?
No, because it was higher.
It was higher. How much higher is? 32 versus 34.
2,000.
2,000. 2,000 will be favorable or unfavorable?
Unfavorable.
Unfavorable, because we're overspending. So, what's the variance for the indirect labor hour when the flexible budget is 8,000 hours compared to the actual results? And the answer will be 2,000 unfavorable, correct? And we can easily see it that that's exactly the truth. 2,000 unfavorable. Now let's see the next thing. Next thing is indirect material. For the indirect material, we're budgeting to spend $24,000 when we're using the machine 8 hours. In reality, we're spending $25,500. Is that good for us or not?
Not good.
Are we overspending or underspending?
Oh,
Overspending.
How much?
1,500.
1,500. So if somebody asks you, what's the variance for the indirect material when the flexible budget is 8,000 hours compared to the actual results? Your answer will be
well, 1,000.
unfavorable, correct? Okay, how about power? For the power, we are anticipating in our budget, flexible budget, if we use the machine for 8,000 hours, we to spend $4,000. In reality, we're spending $3,800. Is that good for us or bad for us?
Good.
Good.
Good for us.
So how much will be? How much good is?
200.
200.
200 favorable or unfavorable?
Favorable.
Favorable.
Favorable, correct. So let's see now. In reality, that's what's happening. So let's compare again based on the static budget what we get and based on the actual results. So if we compare the static budget to the actual results, we find out that we saving 11,650. But when we convert the static budget to the level of the actual results, now we actually figure out that we are losing $3,350. So technically we're overspending. Again, 11,650 when we're comparing static to the actual. When we're comparing the flexible adjusted to the level of the actual results, showing that we're overspending 3,350. That's a huge difference, isn't it? So for what purpose we can use the static budget then? We can use the static budget only and only for the purpose to see what's the change in the activity, and that's all. So the static budget, we're gonna use it only for the difference between the original and actual usage of the activity. Nothing more, nothing less. Flexible budget, we're gonna use it for the control purposes. So we're gonna adjust the static budget to the level of activity on the actual results. We're gonna run the new numbers using the same assumptions that we did to prepare our static budget. And then we compare the results, and that's what we're gonna use for the control purposes. Now, what kind of budget's gonna use the non-for-profit organizations? Non-for-profit organizations, we're gonna the way they're going to prepare the budget is exactly the same as we used last time. So what will be those? That will be municipality, provincial federal governments, hospitality, university, association, and some non-for-profit organizations. They all can follow the same approach for preparing their budgets. Now, since we know that the static budget doesn't help us to identify the variances, and we know now that we have to move to the variable budget, flexible budget, let's go now and cover our variances chapter, which will be chapter now 10. First thing that I want you to understand is cost is always mathematical function of two variances or two variables. Again, cost is mathematical function of two variables. One of the variables is the quantity, the other variables is the price or cost per unit. Once those two combine together, we're going to get the total cost. So since we know that, and we know that we have two variables, in order to come up with the standard cost, we have to come up with the standard for the quantity, and we have to come up with the standard for the price. Quantity standards always and always going to be how much input we should be used in order to produce a product or to provide a service. Cost or the price standard always going to be the price that we supposed to pay for the each unit of the input of the quantity of material or service or product that we planning to use. So again, now we're going to have standard for the quantity and standard for the price. Those two together is going to give us standard cost. Why? Because they're both on reality of our standards. Any deviation from the standards, I have to bring to attention to the managers. They have to be investigated. And that practice of identifying the differences between actual and the standard and bringing the differences into the attention of the managers is known as management by exception. So every time when you see the deviation from the standards and you take a corrective action, that means you're working as a management by exception. What will be the natural cycle for variances? First, remember, everything starts with a report. We have to prepare the standard cost performance report. Once we prepare that report, we're going to compare the actual results with our budget. We're going to see, do we have variances or not? We're going to analyze the variances, and only the significant variances will be the one that we're going to brought to our attention. Once we have those variances to our attention, in order to understand the variance, what that variance happened, and why is that significant, we have to identify questions. Once we identify the questions, we're going to address the question to the person who is responsible for that particular part of the cycle in our company, and we're going to waiting to receive the explanation. Once we receive the explanation, then we're going to take corrective action. We're not taking corrective action before getting the explanation and before identifying questions. Once you see the variance, don't automatically assume that you understand the variances and know from what caused the variance. You still have to do your diligence to go through questions first, wait for the responses, and after that to take the corrective action. Once you take the corrective action, then you're gonna wait for the next period to happen. Once the next period happens, you're gonna prepare the report, and we're gonna check again what you're planning to happen versus what actually happened. Once you compare those one, again, you're gonna find the variances, if there are any variances, and continue with the same cycle over and over until the next period. Next period again. So the question is, how are we gonna set our standards? We have, now we understand we have to have a standard for the price, and we have to have standard for the quantity. Now, ideally, we'll try to get everybody involved in our organization in order to come up with those standards. And we're going to ask the people who are actually responsible and have more knowledge about the quantity usage and price. For the quantity, we're going to ask engineers, production managers. They'll be the one who knows how many materials and how much materials has to be used in our production. For the price, we can ask the purchasing agents and accountants. And we're going to identify that there are two common standards. One is the ideal standard. Now, ideal standard can be only and only attained in the best circumstances, which pretty much never exist. Under those circumstances, which are perfect circumstances or best circumstances, we assuming the employee working on the 100% efficiency all the time. Now the question is that possible? Is it possible? How many of you are working? Is there any of you who actually working? Okay, some people raise their hands. I'm working. So question is, how many hours you working?
Between 10 and 15 a week.
10 and 15 hours a week. So how many hours is this per working day?
It changes, but usually are like 4 hours a day.
4 hours a day. Let's pretend you're working 8 hours. Have you ever worked 8 hours per day? 7.5, 8 hours. Okay, let's say you're working 8 hours. Out of 8 hours that you work, you're paid, when you work 8 hours, you're paid for 8 hours, correct?
Yes.
Now, out of those 8 hours that you're paid, how many hours you actually work on the 100% efficiency? %, where that's gonna bring us on the 8 hours times 0.80, that's gonna bring us to 6 hours and a little bit more than 30 minutes. Is that realistic? What do you say? Out of 8 hours that you're paid, is it realistic you to work 6.5 hours on the 100% efficiency?
I think so.
So what will be the normal? I think more than 5. Okay, depending on the job. So now you understand that ideal standard will be if you work 8 hours and you paid for 8 hours, you to work 8 hours on the 100% efficiency, which, as we agree, it's pretty much impossible. So what's the next thing? Next thing is the practical standard. So we have to come up with the practical standard, which practical standard is tight, but realistic and attainable, which require reasonable and although highly efficient effort by average employee. Now here comes the point, what's the average employee? And which opens a lot of discussion here. What's the average employee? What is the level today of the average employee? Is the level of the average employee today higher than the average employee 20 years ago? Or the level of the average employee today is lower than the average employee 20 years ago? What do you think? Any thoughts on that? Are you guys there? Lower or higher? I don't know, that's why I'm asking. Okay, different opinion. Okay, that's good. It's good when you have opinion. That's what I want you to do, to have opinion. So let's continue. So for that reason, we have to set up the standard for the price, and we have to set up the price standard for the quantity. What will be the standard for the price? Our standard price will be the per unit, obviously, and then that will be the price of the final delivered cost of the material, which discount is deducted, and including shipping, receiving, and any other cost. Now, what will be the standard quantity of material that we need to use for 1 unit? Well, that will be an amount of the material to produce that unit, plus any allowances for unavoidable waste, spoilage, and other normal inefficiency. Having that in mind, let's think about what will be the standards for the direct labor. If those are the standards for direct material, what will be the standard for direct labor? The standard for direct labor will be the rate per hour that we actually pay. So if somebody pays you $20 per hour, is that the cost for the employer? Obviously not. What will be included inside? The cost, $20 plus Canada pension plan that the employer has to pay, plus employment insurance, plus any benefits, and any other cost which are related to the employee who is paid $20. Now, in order to produce 1 unit, that employee has to work. What will be the standard hours that employee has to work in order to produce 1 unit? That will be the time and the labor, which is determined by the amount of the time to complete 1 unit, plus any allowances for normal inefficiencies. Now let's see what will be the standard for the variable overhead. We're going to have the price standards and the quantity standards. For the price standard will be the rate of the variable overhead portion of the predetermined overhead rate, and the quantity will be the usage of the activity of the allocation base, which is used to calculate the predetermined overhead rate. Once we have those, we can come up with the cost. Quantity again, times the price per quantity, we're going to get the cost for direct material. For labor, we're going to get hours for 1 unit, times the rate for that unit. For rate for hours, we're going to come up with the cost, direct labor cost for 1 unit. For the overhead, hours that we need, we're applying the variable overhead times the variable overhead rate that we applied per hour, and we're going to get the variable overhead cost for 1 unit. In this reality, our standard unit cost is $72. Now, why do we have to prepare 2 standards? Obviously, because the cost has 2 components. One is the quantity, the other one is the price. Also, because we have different people responsible for different purposes. Purchasing manager is the one who is responsible for the material price, and the production manager is responsible for the quantity of the material used. Also, buying using activity happen in different times. Raw material can be purchased, then held in the inventory, and later on used in the production. Is the standard same as a budget? No, it's not. Budget is for the total cost, where the standard is for 1 unit. However, can we use the standard when we're preparing the budget? Absolutely. Yes, we can. Now, for the general model of the variance analysis, we're going to have price variance, and we're going to have quantity variance. Since we know that the cost is comprised by 2 variables, which is price or cost and the quantity. For that reason, we're going to have price variance and the quantity variance. Price variance will be the difference between actual price that we pay versus the standard price that we apply to our standards. Quantity variance will be the difference between the actual quantity that we're using versus the quantity that we're supposed to use based on our standards. How are we going to name it? The price variance for the direct material will be called direct material price variance. For direct labor will be direct labor rate variance. For variable overhead will be the variable overhead spending variance. The quantity variance for direct material we're going to call direct material quantity variance. For labor it's going to be called direct labor efficiency variance. And for the variable overhead is going to be variable overhead efficiency variance. Now we have to come up with some structure. At this point, I'm going to flip to Excel spreadsheet. I'm going to start working with the Excel spreadsheet. Just give me a second. To set up one quick Excel spreadsheet, and then I'm going to open it for you. So you can actually see it. Okay, I'm almost done. Just give me a second. Make it a little bit bigger, and I can share my screen now. Can you guys see my Excel spreadsheet?
Yes.
Awesome. So on one side, we're going to have actual cost. And on the other side, somewhere here, we're going to have standard cost. Now the question is, how are we going to calculate the actual cost? Actual cost, we're going to calculate it when we see that will be for direct material. Let's start with direct material, and we're going to start building on that one. And we're going to move to the direct labor and variable manufacture overhead. Direct material. How are we going to calculate the actual cost? Well, we're going to have the actual quantity, and we're going to have the actual price. Once we time those two together, actual quantity times actual price, that's going to give us actual cost, correct? Make sense?
Yes, I think so.
Okay. That's our actual cost. How about the standard cost? How are we going to get the standard cost? If we're getting actual cost, actual quantity, actual price, how are we going to get the standard cost? What do you think?
Would it be standard quality or hours times
Standard
standard
quantity
price?
time
Yeah,
standard price.
standard quantity. Yeah, yeah, that's what I meant.
Excellent. Yep, that's exactly what it's going to be. And you're absolutely correct. That's exactly how we're going to get this standard cost. Now the question is, here I'm going to have a number, correct? Those two are going to produce one number. Let's insert some of those shapes. Those two numbers, actual quantity, actual price, going to give me the cost, correct? Then I'm going to have exactly the same here. Those two are going to give me another cost, correct? Are you guys with me?
Yes.
Yes.
Now the question is, can I compare the actual cost with the standard cost? Yes, I can compare it, but if, for example, I decide to have a party, Christmas party, I'm inviting 50 people, I'm spending $20 per person, so my cost should be $1,000, correct? In reality, my actual cost is $1,500.
So what is it mean?
So the question is, do I know why I'm spending more? Is it because more people came or because cost per person is higher? Obviously it will be hard for me to do this analysis. Why I'm spending $500 more? Is it because of more people or because cost of the person? So those two doesn't help me. I have to have something in the middle to help me to solve this problem. What will be the middle? In the middle, I have to have a number which have partially number of the actual cost and partial something from the standard cost. What will be that? In the middle, I'm going to have actual quantity from the actual cost, and I'm going to get the standard price from the standard cost. Once I do that, now I can compare this number with this number. Why I can compare those two numbers? What's common in them, those two numbers? In those two numbers, in those two equations, what's common for me? Standard price, right? So if I eliminate the standard price, this number here is going to give me effect of the change of the quantity and quantity only. Between those two numbers, since the quantity stays the same, I can see what's the effect of the change of the price between standard and actual price. And now when I compare 1,000 with 1,500, I can see what's the effect of that change because of the quantity and what's the effect of that change because of the price. Make sense? For that reason, what we're going to do, this one, we're going to call it price variance between those two numbers. That will be our price variance. Let me flip it a little bit low. Like this. And this one will be my quantity variance, since I'm doing this for the direct material. Make sense?
Yes.
So once we have the price variance and the quantity variance, then I can calculate my overall spending variance, which will be, let's say this number is gonna come here somewhere in this cell, and that number is gonna come to that. Let's open this cell a little bit and that cell a little bit. And then from those two, we're gonna get our spending variance. Okay. Now we have to start working with the numbers and see how we can actually use these formulas and what kind of analysis we can do out of those formulas. Let's start one after another. Let's mark those one. Let me highlight those ones so those can bring your attention. So that's what we need. We need the actual to find on every question, we need to find the actual quantity, actual price, standard price, and standard quantity. All those four variables in order to come up with the variances. Let me do some additional formatting here so I don't have to do it all the time. And my Excel spreadsheet is formatted. Now I can even extend it just to make it more easy for you to see it. No, that's too much. Let's push this one. Can you guys see it clearly?
Yes.
Okay, awesome.
Yeah.
Let's start working then. I'm gonna go back to the slides to cover the slides. And we're gonna go back and forth with the Excel spreadsheet. By the way, is going back and forth with the Excel spreadsheet, did that help you?
Yeah, I think it did.
Yeah, for me too.
Okay, awesome then. So again, on one side, we're gonna have actual quantity times actual price. On the other side, we're gonna have standard quantity, standard price. In order to eliminate the price and see what's the effect on the change in the quantity, we're gonna state the price in the same reality, standard, and we're gonna see the effect of the changing from the quantity from the standard to the actual, and that will be our quantity variance. Once we leave the quantity in the same reality, actual, and we leave the price on the standard in actual, we're going to see what's the effect on the change of the price, and that will be our price variance. Overall variance between the price and the quantity is going to give us the spending variance. Okay, let's continue now. That's the explanation of what I just said. And what we can do is we can highlight the letters. And what we're going to get, the price variance for direct material will be the material price variance. For labor will be labor rate variance. And for the variable overhead will be variable overhead spending variance. Quantity variance for the materials will be material quantities variance. For the labor will be labor efficiency variance. And for the variable overhead will be variable overhead efficiency variance. So let's see this question. I'm going to copy this question and I'm going to flip it to our Excel spreadsheet. I'm going to share the Excel spreadsheet. First, let's paste the question. Let me move here first the chart and then paste the question. Let me see how can I place it. I can place it like this. Can you guys see the question?
Barely. It's like a bit
Yeah.
too.
Just a second. I'm trying to grab it and shrink it like this. And now we can see it, right? Can you see it now?
Yeah.
Yes.
Okay, awesome. Let's start working. I need one level here, and I need this one to be. So first thing first, this company has the following direct material. So we're doing the standard for direct material standards. They have the standards for direct material. So those are the standards. For 0.1 kilogram, fiber fuel, which is the fiber fuel they're using to demount and parker. For 0.1 kilogram of fiber fuel, they're paying $5 per kilogram. Now, our $5 here will be our standard price. Make sense?
Yeah.
So we have our first number from our equation. That standard price will be equal to the standard price, so that's also will be $5. Correct? Next thing, last month, 210 kilograms of this fiber fuel were purchased and used in our production. So what's the actual material that was used in our production? $210 kilograms, correct? So the 210 kilograms will be the actual quantity. And 210 kilograms here. So at this point, I have my first number, which is 210 times 5. And that 1050, that will be dollars. So I have my first number right there. Let's see what else I can get. This company used those 210 kilograms to produce 2000 units. Let's put somewhere here 2000 units. That's how much they produce, correct?
Yes.
Yeah.
The total material cost is $1,029. So here the total material cost, the actual cost, total cost, which is quantity times the price, is $1,029. Once I have the total cost, can I calculate my actual price?
Yes.
That will be the total cost divided by actual quantity. For my actual price here in this case will be $4.90. Now the last piece that I'm missing is my standard quantity, correct? But I know how many units I produce, correct? I produce 2000 units. Now for 1 unit, based on my standard, how much materials I need?
0.1 kilograms.
0.1 kilogram, correct? 1 kilogram. That's how much I need. And that dimension is kilogram. So in total, how much materials I need?
200 kilograms.
Needed to produce 2000 units. In total, I'll need 2000 times 0.1. I need 200 kilograms, correct? So the 200 kilograms is the one that I'm missing. So at this point, can I calculate my standard cost?
Yes, it'd be
2000
1,000.
by 5, that's gonna be 1000. Let's make in dollar amount to be more interesting. And now I have everything, correct? At this point, I have everything that I need. So how much will be my price variance? That's the first question that we have to answer, right? How much will be my price variance? Can I calculate it?
Yes,
It will be
$21.
this one minus that one. It will be $21. Now, what is this for us? Favorable or unfavorable? Is it in our benefits or is against us? Is it good for us that we
It's good for us.
good for us? Why? Because we supposed to spend $1,050, but in reality we're spending $1,029. Correct? So the $21 will be favorable. Okay. How about here? What's the variance here?
It's $50 not good.
$50 not good. How are we gonna say it? Unfavorable. If the other one is favorable, this should be unfavorable. Make sense? How much is our overall spending?
$29 not good.
How we calculate it? We can calculate it two ways. 50 minus 21. It will be 21, 29, or 1,029 minus $1,000. Still gonna be 29. Unfavorable or not good, as you say. Okay. How else we can get this 21? Watch this. How much is the difference in the standard price?
10 cents.
10 cents. On how many kilograms?
210 kilograms.
110 kilograms times 10 cents. How much is going to give us?
21.
21. That's another way to calculate it. How are we going to get this 50? Watch this. How much is the difference in the quantity?
$10.
10 kilograms.
Oh, sorry, 10
10
kilograms.
kilograms. Times $5,
50.
$50. That's another way to get it. Make sense? Now, since we see those variances, as you can see, there's a variances, there's a fluctuation in the numbers, right? Generally, are we losing money or are we making or are we saving? Where we are? Saving or overspending?
We're spending.
Overspending. $29, right? So once we see overspending, we're gonna start thinking, okay, well, I understand what's happening here. We're supposed to use to produce those 2,000 units, right? To produce those 2,000 units, we're supposed to use 200 kilograms based on our standards. And for those kilograms, we have to spend $5 per kilogram. In reality, we're using 210 kilograms or 10 kilograms more. Because we're using 10 kilograms more, that cost us $50 extra. What else happened? Based on our standards, we're supposed to spend $5 per kilogram, but in reality, we're spending $4.90. So basically, we save $10, 10 cents per kilogram. That gives us a saving of $21. But the $21 savings from the lower price is not enough to overcome the $50 overspending because of the increase of the usage of materials. For that reason, we have $29 overspending between our standards and the actual price that we spent for the materials. So now we understand why we're spending $29 more. Because we're using more materials, 10 kilograms more materials. However, we paying 10 cents less than kilogram for the more materials we're losing $50. For the savings on the cost, we're saving $21. In overall, we're losing only $29. So once we know this, the other thing that we have to do as every human being, when we see something which we don't like, we have to find somebody to blame for. Or in other words, to find somebody responsible. Now, for the quantity variance, the responsible person will be project manager or product manager. For the price variance, the responsible person will be purchasing manager. Purchasing manager is the one who purchased the materials. Production manager is the one who using the materials in the process of preparation of our product. Now, since we know that, and since we see that we're losing $50 of overusage of material and $21 we're saving because of the price. We know the price for the price variance responsible is purchasing manager, and for the quantity variance responsible is the product managers. Which managers did better job?
Purchase manager.
Purchase manager. So what do we have to do? Reward the purchasing manager and punish the production manager?
Yeah.
Yeah.
Yes. Natural answer will be yes. However, we're forgetting something. What was that we're forgetting? Let's go back to the slides. And see what the slides tells us. Here in the very beginning, what we said. We said that first we're going to prepare the report, which we prepared the report. We're going to analyze the variances, correct? We analyzed the variances. We saw that you overusing the material and we're spending less for the material. And what we did after? We jumped to a conclusion and punished the production manager and reward the purchasing manager. What we've missed? What did we skip here?
The receiving explanations part.
Exactly. We skipped the most important part. Identifying the questions and asking for explanation. So what that tells us? Don't jump to conclusions and don't jump on the final action, corrective action, before you ask the questions and before you give the other person or the person responsible chance to give his explanation. Because, let's go back to the Excel spreadsheet. And because, since the production manager is the one who losing more money, let's go and ask him, hey, why do you using more material? And imagine this, production manager look at you and say, well, what do you want me to do with this low quality material that the purchasing manager gave me? It's a low quality. In order to maintain the quality of our products, first, I have to use more material. Second, because of the lower quality, the machine starts giving me defects. My spoilage increase. I'm throwing material because of the crappy material, of the cheap material, the machine give me defects. You're lucky that I was able to use only 10 more kilograms in order to produce the same amount of the product with the same quality, that normal quality. So now question is, what will be your corrective action now? Who did better job now? Who to blame for this?
We need to speak with the purchase manager to see why he changed the materials in the first place, right?
That's correct. So always ask questions and wait for the explanation, but ask the right questions and wait for the explanation, because buying cheap, it may cost you money. Can you see it? This is the perfect example how buying cheap material can actually cost you more. And you have a lot of examples in your life when you're jumping on something cheap. Even I have a lot of examples in my life when I see something which looks like a very good deal, which is cheaper, and turns out to be way more expensive. Correct? Do you understand what I'm talking about?
Yeah, it's almost like, getting like a musical instrument, like from Long and McQuaid versus another crappy store. Long and McQuaid is the better store for musical instruments
How do you know that?
because, like, back when I was in elementary school and high school, I was in band class, so I played the flute. Like
Okay,
the teacher
okay.
told me that like Long and McQuaid, like they're the ones to go for when buying flutes and like musical instruments. But like even with Long and McQuaid, like I also play the classical guitar as well. And like one of my uh private guitar instructors told me that like don't go for this brand of guitar because like they're Canadian made, but like they they're like they're crappy material even though the store personnel may tell you otherwise. So like those are things you want to watch out for when purchasing something, like even if it looked at a high price in some situations.
Interesting. I'll tell you why it's interesting and why I ask you so many questions about where you're getting the instruments, because my two kids play in the band. The boy actually playing flute and the girl playing clarinet. And that's how I know, what was it, Laurie McLean. Interesting. Okay, so the dilemma here, or the moral here is, don't always buy cheap because you might end up spending more. And in some country, there's like a saying, like I'm not rich to buying cheap products. So let's go back to this slides now and continue the slides and see what the slides have for us. Once we saw all those things, let's go back to our chart and our question. And once we go further, we're going to see exactly the same thing that we did on our Excel spreadsheet. The only thing is those parts are a little bit more fancier. Maybe I should use those one, huh? What do you say? Look like a mustache here rather than this. Anyway, the actual, how we're gonna get the actual price, total cost divided by the actual quantity of the material is gonna give us the actual price. How we gonna get the standard quantity? The units that we produce, the actual units that we produce, time the amount of kilograms that we need based on our standards to produce those materials, those products, that will be 200 kilograms. And that's how we get our quantities. The other way to get it is, again, the difference here is 10 kilograms times $5, $50. 10 kilograms difference here times $5, $50. The other number you can get it is 10 cents. 10 cents change in the price times 210 kilograms, $21. Or here, 10 cents reduction of the price times 210 kilograms, $21 favorable. Responsibility. Production manager always responsible for the material quantity variance, and purchasing managers always responsible for material price variance. Now, the standard price is used to compute the quantity variance. So the production managers is not held responsible for the purchasing manager's performance. Now, if the purchasing manager, however, buying cheap material, then production manager needs to use more of that material in order to maintain the same quality of the product. What can cause increase in the price? That may be different things. It was very interesting in the back in days when I was teaching this course. There was one of the questions I actually asked student to identify what will be the possible cause of increasing the price. Do you know what this one student come up with this? And I said, any explanation which is logical and makes sense, it's going to be considered. So one of the students, she came up with the following idea. The price of the material went up because the truck driver had a flat tire. He has to stop and he has to replace the tire. That took him 2 hours, and that's because of that the material price increase. And I said, okay, that's a very good explanation. And she get a very good point. So let's go now and practice what we just learned. I'm gonna copy this and I'm gonna move back to the Excel spreadsheet. Share my screen, go to the Excel spreadsheet, and let's do the same question again. Let me copy this worksheet, move this one away. I don't need this one anymore. And I'm gonna post the new one. Can you guys see it? I don't need this, I don't need this, I don't need this, I don't need this, I don't need this. I don't need this. Actually, what I miss here. I don't need this, I don't need this. This. Let's get rid. No, we those can stay. Okay. And those units are gone. All right, so this company has the following direct material standards. We still on the direct material standards to manufacture one product, one ZP. 1.5 pounds per one product at cost $4 per pound. So how much is our standard cost for the direct material? Again, how much is our standard cost per pound of direct material? Can you guys hear me?
Yeah, I can hear you. It's just
So-
that I don't know how to answer that question.
So out of this question, so we have the following standard. The following standard is to produce one product, we're supposed to spend 1.5 pounds for one product, and we're supposed to pay $4 per pound. based on our standard. So since we know that we're doing the variable analysis here for the direct material, how much is our standard price per pound of the material based on our standards?
$4.
$4. Thank you. Let's move on. $4. We have our first number, $4. Let's put this one in dollars. Okay. What's the next thing that we need? Last one, next thing that we know. Last week, 1,700 pounds of material was purchased and used. So what's the actual quantity that we used?
1.7 pounds.
1,700 pounds, yes. You're correct. So that's going to give us our first number, right? 1,700 times $4, $6,800. We have our first number. What else we know? We produce how many products? How many units? 1,000 units, correct? And the amount of the cost, the money that we spent on the direct material is $6,630. That will be our total cost here, right? 6,630 is right here. So once we plug this number, we're going to find out that our actual price is per pound that we paid for that material is $3.90. Now, the only thing that left is to find out how much is our standard quantity for the direct material which is needed to produce 1,000 units. Now, based on our standards, in order to produce 1,000 units, how many pounds we need to use?
1,500.
1,500.
Or 1,005 pounds per unit, which is going to give us 1,500 pounds, correct? So 1,500 pounds is our standard quantity. Since we know that now standard cost is based on our standards, in order to produce 1,000 units, we need to spend 1,500 pounds of material, which material based on our standards cost us $4, so we're supposed to spend $6,000. In reality, we're spending $6,630. Now, what's happened? Well, what's happened first is we're using more materials. Can you see it?
Yes.
How many more materials we using? How much more materials we using?
200 pounds more.
200 pounds more. How much is the cost per pound? It's right here.
$4.
$4. So 200 times $4 is going to give us
$800.
$800 right there. So because we're using 200 pounds more material, that cost us $800 more. Make sense?
Yeah.
Let's move now to the price variance. What's happened with the price? Per pound went down, correct? How much down was the price? Is the price now?
10 cents per
10
pound.
cents per pound. Over how many pounds?
1,700.
1,700. So that's 1,700 pounds times 10 cents gonna give us $170, correct? So because the price of the pound went down with 10 cents, we're saving on 1,700 pounds, we're saving $170. Make sense?
Yes.
So, so
Okay.
if somebody now, if somebody asks you, if the manager, the owner of the company says, "Hey, what's going on here? On our standards, we're supposed to spend $6,000. I check the bill, we're spending $630 more. Why? What will be your answer?"
We use more quantity.
Okay,
We use
Uh,
more pounds to produce the same amount of material.
okay. Product, same amount of product. Okay, and
Could it also be inflation as well? Because like I remember in my marketing class that like
no. Here we're not talking about the inflation. We're just staying with the case here. Inflation, I know in the marketing or if you go into economics, we're gonna consider all those the other things. Here we try to keep it simple, stay with the case, with the question here. I know you're right, but let's stay with the question. So what we have to answer? We have to answer that because of we're using more material, because of that we overspending $800, but we managed to get a cheaper material, which saves us $170. For that reason, in overall, we're spending $630 more. Make sense? Do you guys understand this logic and this explanation?
sorry, can you explain that one more time? I kind of got lost on the part where like you said like the answer to when your manager tells you how hey how much like where's the 630 coming from? Like how would I exactly respond to that question exactly?
Okay, so we're clear that we're spending $630 more, correct?
Yeah.
So why are we spending 630? Because first, we're using more materials.
Okay.
Because of overusing the materials, we're overspending $800.
Okay.
However, we managed to purchase the material cheaper with 10 cents, which create saving of $170.
Okay.
For that reason, our overall spending is $630.
Okay.
Make sense? $800 overspending, $170 saving. So in overall, we overspending $630 only.
Okay, that makes sense.
All right, let's go now to the slides again. Here we go. What's going to happen here? Material price variance. How much will be our material price variance?
C.
B, 170 favorable. Yes, that's correct. And how much is our material quantity variance?
Say what? Oh, no,
800 unfavorable, correct? So the answer will be C.
wow.
So if we have to prepare the
Oh,
same
it's
thing,
so cold in there.
we
Huh?
have to do
I'm not
something like
exactly.
this. Correct? If we have to prepare the same chart that this looks like exactly the chart that we prepared, and we're getting the actual price when we get the total price divided by actual pounds purchased and used. And the standard quantity we're getting as a number of units, 1000 times 1.5 pounds per unit. And we're getting the standard quantity. Now, variances should be isolated and brought to the attention of the manager as quickly as possible, and only the significant variances should be reviewed and investigated. Now, at this point, we're seeing only the example when we purchasing and using exactly the same amount of material. Is that always going to be the case? Probably not. For that reason, we have to adjust our mindset to the new reality, which reality will be, we're going to purchase one amount of material, but we're going to use different amount of material. What's going to happen if that happens? So let's copy this question and let's move to the Excel spreadsheet and let's solve it there, doing some adjustments. Gonna copy this the spreadsheet again, get rid of this question, post a new one, and let's work with the new one. Gonna make it small so we can fit here on the screen like this. So in order to solve this question, I have to do again some modification, which modification will be up to this point. And let's see how this is gonna continue. First one first. I'm gonna erase everything and gonna start from scratch, like this. So first thing first, this company, again, they're producing the ZP for direct material. We're talking about direct material standards. They're using 1.5 pounds for one product, and cost per unit is $4 per pound based on our standards. So the $4 will be our standard price, correct? So we're gonna plug here $4 and here $4, and we have our standard price. Now, last week, 2,800 pounds of material were purchased at a cost of $10,920. So what's the actual amount of the material that we purchased? That would be 2,800 pounds, correct? That's the amount that we purchased. So here we're going to have our first number, which is 11,200. But we actually paid 10,920. So our actual price is that we pay is $3.90. So we get our price variance. 11,200 minus 10,920 to $280. How else we can interpret it? 10 cents decrease in the price over 2,800 pounds that we're purchasing. That's going to give us savings of $280. And we're done. Now let's continue with the question. And 1,700 pounds were used to make 1,000 ZPs. So now the quantity, the actual quantity that I use in my production is 1,700 pounds. So now I have two actual what we purchase and actual what we use. So what shall we do? Well, simple thing. We're gonna prepare for the quantity variance. We're gonna use the amount of the material which was used in production. For the price variance, we're gonna use the amount of the pounds of material was actually purchased. So For that reason, what I'm gonna do is I'm gonna push this one down, literally. Before I push it, I'm gonna do this. And I'm gonna come up with the new things. So what I need those two. And I'm gonna post them right here. I should have pushed it a little bit lower. Let's push it a little bit lower. And I'm gonna copy those one. And I'm gonna move it down. Just like this. So again, from here I'm gonna get my price variance, 280. In order to get the quantity variance, I have to use the amount of the pounds that I use in my production. The actual quantity that was used in our production is 1,700 pounds. And that gives us a number for the actual quantity times standard price. For the number of units that we produce are 1,000. And since based on our standards, we're supposed to use 1.5 pounds for 1 unit, that gives us 1,500 pounds of material that we need to use. Once we get this number, we can get the quantity variance, which in this case, it will be, let's see if this is correct. No, that's not correct amount. That will be 800 unfavorable. Make sense? So basically, for different purposes, we're gonna use different amounts. For the price variance, we're gonna use amount of the material purchased. For the quantity variance, we're gonna use the amount of the material used. In this case, we're not gonna have a spending variance because I cannot compare the amount of the standard cost, which is based on the units of production, and the actual cost, which is based on the direct material purchased. Make sense? But I'm gonna have price variance and I'm gonna have the quantity variance. Let's go back to slides and see how the slides again. For the price variance, we're gonna use only the purchase price and the amount of the material that we purchased. For the quantity variance, we're gonna use the quantity of the material used in production versus the quantity of material needed based on our standards to achieve the actual number of production. And we're done with the direct material variances. Now let's see direct labor variances. For direct labor, we're gonna start prepare the same chart. So I'm gonna copy this and I'm gonna move again to Excel spreadsheet. For direct labor, we have to do some modifications here. This is for direct material. For direct labor, let me show you how this is gonna change. First the name is gonna change. Instead of direct material, it's gonna be direct labor. Second, actual cost will be the actual hours times the actual rate. Standard cost will be the standard hours times standard rate. In that case, in the middle, we're gonna have half of the actual and half of the standard. Actual hours times the standard rate. Here we're gonna have not price because we actually,
Evan,
yes,
Evan, for the middle part should be SR. It should be standard rate, is it?
which one?
The middle part, it should be actual hour and the standard rate.
Standard rate, yes, that's correct, standard rate. That is correct. So here for the variance, we're gonna have rate variance because that measure the arch, since the hour stays the same and the rate is different in reality, we're gonna have the rate variance. And on the other variance, we're gonna have efficiency variance. Efficiency variance. The overall variance, we're still gonna be spending variance. Those are the adjustments that we have to do in order to start calculating direct labor. So I'm gonna use this worksheet. I'm gonna flip it here, get the question. First, let me get rid of this one. I'm gonna copy the question from the slides again, and I'm gonna come back to Excel spreadsheet. Okay, let's delete this, delete this, delete this, delete this. Okay, so I have to change it. Actual hours, actual rate, actual hours, standard rate, standard hours, standard rate. And here we're gonna have efficiency variance. Variance, and the other one we're gonna have a rate variance. Okay. So let's see this question. This company has the following direct labor. That's not direct material, that's direct labor. Direct labor standard for 1 unit, which is Mountain Park. In order to produce 1 unit based on their standards, they're supposed to spend 1.2 hours. For which hour they pay $10 per hour. What will be the $10 here?
The standard.
Standard rate, right? Standard rate is $10. So we have our first number. We have the rate. What else we know? Last month, the employee actually worked 2,500 hours. What's the 2,500?
Actual hour.
Actual hours, 2,500 here and 2,500 right here. So we have our first number, which is 2,500 times $10. That should be $25,000. Now, once these people work 2,500 hours, the total labor cost was $26,250. Where that number is gonna go? That will be the total actual cost, correct? 26,250, right here. Once I have this cost, can I calculate my actual rate?
Yes.
Yes, this one divided by 2,500 is gonna give me $10.50 is my actual rate. What's the last number that I need? Standard hours. How am I gonna get that number? Well, I'm gonna check how many units I produce. 2,000 units. Based on my standards, how many hours I need to produce 1 unit and 1 unit only?
1.2.
1.2. So in total, I need how many hours?
2,400.
2,400 hours. So 2,400 hours will be my number here. So can I calculate my standard cost? Yes. My standard cost will be $24,000. So how efficient I am in using the labor? What's the efficiency?
1,000, not good.
1,000 inefficient, right? Instead of efficient, we are inefficient or unfavorable. How about on the rate variance?
1,250 inefficient.
Inefficient or unfavorable. Or my overall spending?
2,250 and
Unfavorable. Make sense? So let's see and think what's happened here. First, we produced 2,000 units. Based on our standards, our workers supposed to work $2,400. But because we pay them only $10 per hour, they figure out that if they increase the hours without increasing the production, they can generate more profit for themselves. So they increase the hours. Because of that, we're losing $1,000 or overspending $1,000. We figure out that our workers start to slowing down their work because we're paying them too less. So we increase the rate with 50 cents. That increase of 50 cents give us overspending, another overspending $1,250. In overall, we're overspending $2,250. How else we can see this? $1,000. How much is the increase in hours? How many hours more we using?
100,
100 times $10,
1,000.
1,000. How about the rate? Rate jump with 50 cents, correct?
Yeah,
But for over $2,500. So 2,500 divided by 2 is going to give us
1,250.
50. So the 2,250 overspending comes first for the increase hours with 100 hours and increase rate with 50 cents. So let's go to the slides and continue with the slides. We can prepare the same chart that they prepare the same chart that we just prepared. And we come up with the rate variance and efficiency variance, both unfavorable. Overspending variance is also unfavorable. We're going to get the actual rate by total cost divided by the actual hours. And we're going to get the standard hours time by multiplying the number of units times the standards to produce 1 unit in hours. This if you want to use the formula. Now, who we gonna keep responsible for overspending $2,250? Well, believe it or not, we're gonna blame only and only one person, and that will be the project manager. Production manager. Because production manager is the one responsible for labor inefficiency and labor rate. Well, what he's supposed to do? First, he has to train the employee, increase the quality of the training in order to reduce the hours that they're spending in production. He has to increase the quality of the production supervision. So he has to be more efficient of monitoring the employees. He has to be able to motivate the employee, even though we're paying them less. Somehow he has to find a way to motivate them. And the last thing that he has to do is to identify which are the exceptional employee, which are good employee, which are the bad employees. So how he's gonna pair them? Or he's gonna get exceptional employee paired with the bad employee. So what's gonna happen in reality? Question for you. What do you think is gonna happen in reality if you're the manager and you have very good employee and very bad employee, and you want to increase the overall productivity and get those two to work together? What's going to happen? What do you think is going to happen?
Depends on the scenario. Like some people don't get along with others because they have different interests and hobbies.
Okay, but no, we're not. So listen to this. You're at work.
Okay.
You're not at your hobby. You're not doing something that you like to do. You're doing something that you have to do,
Okay.
right? People usually, they don't work. How many of you like to work? And you're going to work only because you just like to work. How many of you are those people?
Depends on the job. Like teaching from here.
Well, I'm not talking about myself. I'm talking about you. I'm talking about you guys. Tell me, how many of you are going to work because you actually want to work?
Yeah, it depends where you volunteer as well, prior to getting work experience and so on.
Try to get the work experience, but again,
Very few people actually do.
that's the reality. So if you're going somewhere not because you want to go, but because you have to go, do you have a choice?
No, you don't.
No, you don't. So what you gonna do? Whatever your manager tells you to do. Correct? Having this in mind, now you're the manager. You have a good employee and you have the bad employee. You want to increase the profitability and you want to increase the efficiency in the labor. What's gonna happen? What do you think is gonna happen if you pair that good employee with the bad employee?
Productivity is gonna decrease because the good employee won't want to go to work since it's paired with the bad employee, right?
That's one way to do it. The other way to do it is the good employee. How long do you think it's gonna take him to realize why do you have to work like crazy when this guy is doing nothing and he get the same pay and he's get the pay the same?
He's gonna want to change companies.
Well, that would be one idea. The other thing is he's gonna be now instead of one bad employee, you're gonna have two bad employees, right? Even though your intention is the good employee to elevate the bad employee and to increase the overall efficiency.
Yeah, I agree with Gemini's comment. She said good employees deserve a better pay.
No, out of question, good employee deserve better pay, but listen this. You don't want only want he to you don't want only to spend money. You want to increase the efficiency. Do you understand this?
Yeah, you can actually do stuff like cut vacation hours for the bad employee and like do like those kinds of stuff. I'm not sure if they actually do that in reality. I've seen that in movies.
Okay. So good thinking. So listen to people. Why I'm asking you those questions? Because one day you might be that person who has to deal with this problem. You might be the one who has to deal with the increasing of efficiency. Make sense?
Yeah.
And your efficiency comes from reduction of the hours. Here, can you see it? Efficiency in labor is reduction of the actual hours that you need to achieve the production based on the standards that you have. Yes, you told me I'm going to increase the actual rate to motivate the employees. No problem. I have no problem with that. But question is, once you increase the rate, your rate variance is going to go up, which is still not big deal as long as efficiency goes down. Make sense?
Yeah, one other way to do it would have been like to reward the good employee with like, a certificate or a reference letter.
Well, that if you the question for you,
Okay.
if you get a certificate or reference letter, is that going to motivate you to work harder?
It depends if you're a college student and you want to go into masters or a
No,
PhD,
no, no, no,
they
no,
let
no,
you
no,
look
no,
at
no,
those.
no. You're actually a worker.
Oh, okay.
You're a manual labor worker. You're a construction worker.
Okay.
What's the value of that certificate that your employer give you?
It depends. Like some workplaces, they're competitive and so on. Like to like go into like it is possible that one worker worked there for 10 years, but someone else is brand new to the job and the brand new person could do the better job compared to the other person.
Correct.
Because like there are stuff and factors like that as well with what people are comfortable with doing.
Okay. And we're gonna give him a certificate, not certificate, but like a thank you letter.
Not a thank you letter, but employee of the month. Have you heard of that
Yes, I do
function?
heard of that. Yeah, employee of the month.
Yeah.
Okay, that's a good motivation. Good.
Same
Good.
with teaching, like at
Yeah.
colleges and so on, like ratemyprof.com. Like I've seen one teacher, he's an English professor, and like a lot of his students wrote really good stuff about him, and like a lot more students want to go into his class as a result.
Okay. No,
Whereas,
I see that. I experience that. Yeah.
yeah,
Yeah. No, good thinking. Good thinking. I have to tell you, good thinking. Again, you better think of those things now, because one day you might end up in the situation that you have to motivate your people. Good motivation will be all those certificates, letters. Uh, Yuma, what was the other suggestion?
promotion.
Promotion, anything like that. Or give them some reward, send them to the, what will be that? Extra training.
Yeah, or like give them Starbucks coffees,
Yeah,
like cover their medical expenses and so on.
yeah,
Like those kinds of stuff exists as
yeah.
well with
Yeah, the
employees.
medical expenses, that will be part of the extended health benefits,
Oh, okay.
which will become up standard for all the employees, right?
Yeah, and like if there are family, if an employee has families, we can cover their family members, like protection for eyeglasses and those kinds of stuff.
Yeah,
If the employee was like really good at the job.
good, good thinking, good thinking. Good job, good job. Now let's do another question. Let's see what's happened with the ZP. Let's copy this, move to the Excel spreadsheet, and see how we're gonna solve this problem. Good job, Yumal.
Thank you.
Let's share my screen. Here we go. So let's go with this question and see what's happening with ZP in the same reality, but now we are direct labor. So I'm gonna erase those one again, and we're gonna start from scratch. All right. This company has the following direct labor standards to manufacture ZP. 1.5 hours standard hours for one product for which they pay $12 per one direct labor hours based on their standards. Now the question is, what the $12 would be?
The standard rate.
Standard rate, that's correct. Standard rate is $12. We get our first number. We need how many more numbers? 1, 2, 3 more numbers. Last week, 1,550 direct labor hours were actually worked. What will be that number?
Actually, hour.
Actual hours 1,550. 1,550. And we have our first number, correct? That will be this one time $12, and that's going to be $18,600. From the question now, for those 1,550 direct labor hours, how much actual cost did we pay?
18,910.
18,910. That's our total cost, correct? Total actual cost. So from here, can I get actual rate?
Yes, with a division.
Yeah, this one divided by hours is going to give us $12.20. The last number that left is the standard hours. Which standard hours I need? The standard hours to use for production, correct? How many units I produce?
1,000 units.
1,000 units. And how many hours I'm spending per unit?
1/2.
1.5 hours. So that's gonna give me total of 1,500 hours. So how much will be my standard cost to produce 1,000 products? Should be $18,000, correct? So how efficient we are of usage of labor?
Not very.
Not very efficient, right? So where we are? Overspending or underspending?
Overspend.
Overspending. $600, correct? Why are we spending $600? Because we're using 50 more hours, correct? For the 50 more hours, how much we paying for hours? $12. So that's gonna give us 600 exactly. 50 times 12, 600. Now let's go to the rate variance. How efficient we are on the rate variance? Are we favorable or unfavorable?
Unfavorable by $310.
That will be this one minus that one. $310, we are unfavorable. We overspending, correct?
Yes.
And our overspending variance will be this one minus that one, or those two together, regardless. So our overall spending is $910 unfavorable. Right? Now the question is, what's happened in reality? The hours increase with 15 hours, and we increase the rate with 20 cents. The 20 cents time 1,550 give us 310 unfavorable variance. The increase in 50 hours give us $600 more. Overall, we're overspending with $910. Now let's move to the slides and finish the slides without variance. So the question is, what's our labor rate variance?
Eight.
How much was it?
310 unfavorable.
310 unfavorable. Yes, that's correct. And how much was our efficiency variance?
600 unfavorable.
600 unfavorable. If we have to do the chart, that's what we have to do. And since we already did it, we're done with this. Let's move to the next one. Variable overhead spending variance. I'm gonna copy this. I'm gonna move to the Excel spreadsheet, and let's do it on the Excel spreadsheet again. Now, even though we're moving to the variable overhead, I'm still gonna use this Excel spreadsheet, and I'll tell you why. The variable overhead in these questions is based on direct labor. Direct labor is measured by hours. The rate for the variable overhead is rate, so we don't have to change that terminology. So those numbers gonna stay the same. The only thing that we have to change is the variances. In the variable overhead, that will be the spending variance here. That will be still efficiency, and that will be called, now we're gonna call it overall variance. Overall variance. And we're done with this. So now let's go and calculate the numbers. First thing first, this company has the following direct variable manufacturing overhead labor standard for its mountain park. They using 1.2 standard hours per unit at $4 per unit. So how much is their variable overhead rate? Standard variable overhead rate.
$4.
$4.
$4. Let's apply here $4 and $4 here. Last month, the workers actually work 2,500 hours. What will be the 2,500?
Actual hours.
Actual hours. And here, 2,500. And we have our first number, right? 2,500 times 4, that should be $10,000 right there. They produce how many units?
2,500.
How many units? Here. How many
Sorry,
units?
2,000.
2,000. 2,000. So for the 2,000 units, they actually pay how much overhead they pay?
1.2.
10,500.
No, 10,000.
10,500.
500 units. $10,500 they pay for the total overhead, correct? You can see it. So from this number, can we get the actual rate?
Yes.
And that will be $4.20, correct? So the last number that left is the standard hours that we need. How many units we produce? 2,000 units. How many hours we applying to 1 unit?
1.2.
1.2.
1.2. So how many hours, standard hours, we need for our production of 2,000 units? 2,400 hours, correct? So based on our standards, our variable overhead should be $9,600. But because we're using 100 hours more, our efficiency variance is $400 unfavorable. Make sense? 100 hours times $4, $400 unfavorable. Now on the spending variance, that's another $500 unfavorable. Why? Because the rate increased with 20 cents times 2,500 hours, that's $500. Overall variance is $900 unfavorable. Let's go back to slides. And the slides are exactly what we just did. How we get the actual rate, total cost divided by hours, actual rate. How we get the standard hours, total production, time hours by the standards, 2,400 hours. Let's do the ZP one more time. For this variable manufacturer overhead, and we're gonna stop because repetition is good for understanding, but too much repetition, it's not very good for your brain. So what we're gonna do here, delete this information. Oops, not that one. I wanna keep that one. I wanna delete only the $4 here. Okay, and let's work with the question now. This company, again, they're following the variable manufacturer overhead standard for one ZP. The standard is 1.5 standard hours per unit at $3 per direct labor hours. So what's our standard rate?
$3.
$3. Last week, 1,550 hours workers work. What's our actual hours?
1,550 hours.
1,550. So we have our first number here, this one, time that one. When the workers work 1,500 hours, they produce 1,000 units, and we pay them, and our variable overhead spending was $5,115. So our total cost, total variable, that's not direct labor. Let's change this one to the variable overhead cost. That's not labor, that's variable overhead cost. Here and here. So the variable overhead cost, total cost is $5,115. The last thing that left is the standard hours for the overhead. So we produce 1,000 units based on our standards. we're applying overhead based on 1.5 hours, correct?
Yes.
So how many hours we need? 1,000.
1,500. Yeah.
Yes. 1,500 to 1,500 times 3, that's $4,500. So where we are on efficiency? Efficient or inefficient?
Inefficient.
Inefficient, $150. Why? Because we have increased with $50 on the actual hours, times $3, $150. How about on spending? Oh, we didn't calculate here actual rate. Actual rate will be $3.30. On the spending variance, we are overspending, correct? $465. How are we going to get those 30 cents increase in the variable overhead rate time $1,550? That's going to give us $465 increase. Overall variance here will be $650 unfavorable. Make sense? Okay. Let's go over the slides. Not Excel spreadsheet. Let's go to the slides. Sorry. So what will be our answers here for the variable spending variance?
A.
A, that will be correct. A, how about the next one? Efficiency, how efficient we are. Not very efficient, aren't we?
C.
C, 150 unfavorable. And that's if we have to do the chart that we just showed you. Now, what we're gonna do for the service company? This is if we're running manufacturing company, that's what we have to do in manufacturing company. What we're gonna do in the service company? Well, in the service company, we're gonna apply the same approach for the standards as a manufacturing company. And all the differences should be brought to attention to the manager. And that's where I'm gonna stop today.